Ahead of spring break, investors redeemed $10.0 billion from the conventional fund business for the week ended March 28th, 2012. Hi, welcome to Lippers Fund Market Insight Report. My name is Tom Rosine. Thanks for joining us today. You know, one of the things that people did, we're coming off a really good quarter, and the quarter's just at the end of the day. Obviously, today is Friday, the 30th. And what we're looking at is a return between about 8 and somewhere around 20% for the indices. A lot of people said, hey, listen, spring break's on board. Let's pull a little bit of this hard-won profit off the table and make sure things are right for the next week or two. I mean, they heard some bad news. They had global manufacturing numbers from both Germany and France coming in lower than expected. So that was kind of a weakness that I think people played on. And also we saw new home sales actually come in about 1.6% down below what we had expected as well. So it wasn't a big thing, and I think people are still pretty sanguine with where the market's going. But for this week, they decided to take a little bit of that hard-won profit off the table. Let's see if we go down to the macro group where that money flow actually occurred. Equity funds saw about $2.5 billion in outflows. Again, taxable bond funds did very well, bringing in about $3.9 billion. And muni bond funds continued on their merry way, taking in about $400 million. And then as we take a look at it, the big outflows, again, I told you about $10 billion in outflows. Well, really, $12.2 billion of that was actually from money market funds. And certainly we have expected that. We'll talk a little bit more about the money market effects and taxes here in just a few moments. But if we take a look at the special areas and we focus on equity funds, we see that we had actually the third consecutive week of plus side performance. Mind you, it was only 0.05% as far as returns went for the week, but we really saw the second week in three where we saw outflows. $2.5 billion were pulled out of the conventional fund business from equity funds. Domestic equity funds saw about $1.8 billion in outflows, and non-domestic equity funds saw about, somewhere around $600 million in outflows as well. So it was two, back-to-back, non-domestic, domestic, where we actually saw the outflows come out. But ironically, if we take a look at emerging market funds, they saw about $316 million in inflows. That's just kind of a head scratcher. But again, remember, investors are concerned about the China effect as far as slowing growth, but certainly there is still growth going on there. And again, people aren't throwing in the towel at all. Again, this was a break. So this is what we saw. Investors actually taking advantage of some buying opportunities. If we took a look at ETFs, we saw the SPY, that's a spider, S&P 500 index, actually taking $2.9 billion. So that was a really good inflow for them. And then on the flip side, we saw the Russell 2000, iShares Russell 2000, IWM, actually lose about $1.8 billion. All in all, if we included equity ETFs and took a look at them by themselves as far as flows for equities, well, we saw about $200 million in outflows. So really, people took advantage of this dip, and we believe we're buying on the dip. So while we saw some bad news, $2.5 billion in outflows for equity funds, we really saw some actually pretty good flows and buying opportunities on the ETF side. Well, let's take a look at fixed income funds. That has been a different story. This is the 15th consecutive week we've seen inflows. Now we saw about $3.9 billion in net new money come into that group. We saw the third consecutive week of plus side performance. This one was about 0.19%. Hey, nothing to sneeze at when we were looking at 0.05% for equity funds. But what we really saw was people going after, I'm going to call it safer, but also higher yielding products. So we saw the corporate investment grade debt funds taking about $1.5 billion. Flexible portfolio funds, again, continued on their merry old way, been drawing a ton of money, $1.4 billion for this week as well. So all in all, again, investors weren't looking for treasuries. They weren't necessarily looking for safety. They were looking for yield. It's been a story we've talked about quite some time. I do want to jump back just a moment for the equity income fund thing that we've been talking about for months on end. Equity income funds, this is back to equities, saw about $6 million in inflow. It's the lowest inflow we've seen for them from the conventional fund side. And actually, if we included ETFs into that, we actually saw negative numbers. It's one of the first we've seen in many, many, many weeks. So again, investors continue to look for income in many different places. Predominantly this time, though, it was from fixed income. Let's move that over to the muni bond fund side as well. We saw money flow into this group again. For the first week in four, we saw positive performance, 0.55%, but it was the 17th consecutive week that we saw net new money come into this group. Again, the numbers were pretty good, 403 million, doesn't sound like a lot, but again, remember this is a very small group. National munis took in the lion's share of that flow. They saw about $390 million of net new money coming into all the rest was single state. Well, money market funds is something we've been talking about for quite some time. And of course, this, as I was saying earlier, is where we saw the majority of money leave the coffers. $12.2 billion in outflows. This is the 10th week in 11 that we've seen outflows. So we only have one inflow during that 11-week period. And that was just a few weeks ago. But really, where it's been not a big issue, I think, is because March 15th was the filing deadline for corporates taxes, and of course April 15th is for you and I to make our tax payments as well. So I think people are actually drawing money down. In fact, if we take a look, taxable money markets saw about $9.7 billion outflow. Of that, institutional accounts accounted for $5.5 billion, and we saw that the retail investors accounted for $4.2 billion in outflow, and tax-exempt money markets funds saw about $2.5 billion. Pretty big chunk of change for them in outflows as well. So overall, again, we expected this type of outflow. Corporations paying their taxes. You and I eventually paying our taxes April 15th without a filing deadline. So certainly that was one of the things that we saw. Now, as we move forward, I think over the next week or so, we're going to see a kind of a stalemate. People are going to sit back and watch. We've actually had some pretty good news. We saw that the jobless claims benefits declined to a 4-year low just recently. We heard from Bernanke and the central bank. Basically, they're committed to the policy that they've had that's really kept the market rolling for the last 3 years or so, and easy money is certainly on everybody's lips. It's still going to continue on. But really, I think global growth concerns are out there. We heard, that China missed its growth capabilities and lowered its expectations as well for next quarter. We've also heard that France and Germany, as I said earlier, had differences in manufacturing. Well, we do believe that there's some growth stories. I think people are going to sit back and wait for those numbers to materialize. And of course, we have earnings season, reporting season coming up in the next week or two. And I think people are going to wait for that. So for the next week or two, we might see kind of a flat market. Of course, we're not going to know until that happens. And if you want to find out more about what happened in your area as far as expertise goes, you can go to lipperusfundflows.com and find out a little bit more about the classifications that you care about. If not, you can join us next week when one of the analysts from Lipper will talk about the flows trends. And until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.